In this video, let's explore and examine how the hedge funds managed to get themselves into a position where they lost billions of dollars to the average retail investor. So as many of you may know, GameStop is a retail and online store that offers games and gaming products like the PS5. However, over the years, as online subscription gaming services like Microsoft's Xbox Game Pass have exploded in popularity, GameStop has been seeing decreasing revenues, and in 2019, they actually lost $673 million. That's pretty bad. Noticing the change in the gaming space, large hedge funds began shorting GameStop, I believe from around $20 all the way down to $5 a share. If you do some math, that's a 75% return on investment. Remember that you make money by shorting if the stock price goes down. You would think that 75% is pretty good, but no, these growing hedge funds wanted more. They seemed intent on shorting GameStop into bankruptcy, similar to what may have happened to Toys R Us. One way you can tell how shorted a stock is by something called the short interest, which note that it's publicly available data. This becomes important later on. The short interest is the percentage of shares that are currently sold short, i.e. they need to be covered and bought back at some point in the future. Note that I said that this information is publicly available. Obviously, this means that any average investor like you or me can find this information with a quick Google search. If you've never heard of WallStreetBets, have you been living under a rock? Regardless, it's a group of, as of filming, 7.1 million self-named degenerates who talk about trading in the stock market, often with very high-risk trades involving leveraged positions using options, which I plan to break down later on this channel. Don't worry, it doesn't need to make sense right now though. Experiencing plenty of huge gains, but also massive losses. Anyway, a group of these WallStreetBets members noticed that the short interest in GameStop was unusually high, over 100% in fact, and currently it's sitting at 250%. How does this even happen? How do you short and borrow more shares than actually exist? This can happen with something called naked short selling, where a broker allows you to short sell without actually arranging for the shares to be borrowed. That was kind of a lot, so for a small example, if Alice owns a share of GameStop and Bob borrows that share to sell to Carol, David could borrow from Carol to sell to Elon, and the cycle would continue. In this example, more stocks have been sold short than actually exist on the market. Noticing this, the WallStreetBets members recognized that if enough people bought shares, it would bid up the price of the stock, forcing some shorts to cover and potentially inducing a short squeeze, which I covered in my last video. Most notable among these members is a user who goes by the name Deep Effing Value, interesting, who started buying large amounts of long-dated call options. Don't worry if you don't know what this means, but it basically means putting a huge bet that GameStop would rise in price in the future. As of the end of January 2021, his roughly $750,000 investment is now worth over $30 million. Others began posting about this as well, and presumably a lot of the members in the subreddit began buying and holding a large volume of GameStop shares and call options, bidding the price up to around $40. At this point, Andrew Left, founder of Citron Research, released a video that, after the life of me, cannot seem to find, but it basically said that he's increasing his short position in GameStop, saying that he'll ride the wave down to $20 a share. Unfortunately for him, this video probably actually played a part in the massive buying that ensued shortly after. GameStop increasing sometimes by 50, 60, even 100% in a single day. At the same time, there was another hedge fund, Melvin Capital, who was very heavily short GameStop. As the parabolic rise of GameStop continued, they didn't cover their positions at a slight loss. No, they firmly believed the dumb retail investors were ridiculous and added to their short position. As the shorts added while the price rose, Citron Research allegedly closed their short position at $90, a more than 100% loss. Melvin Capital refused to succumb to the retail investor and actually had to take a cash infusion, or bailout, of $3 billion from the hedge funds Citadel and Point72 to continue their short position. These other hedge funds, notably Citadel, is a very important name for later in the story, and that'll be covered in a future video. And so it continued, the retail investor continuing to buy the stock while the hedge funds piled more and more money into their short positions. As of January 30th, the short interest in GameStop is 250%, and in the next video we'll examine the juicy drama that unfolds, involving retail investors, hedge funds, Robinhood, other brokerages, and more. And remember, if you haven't already, make sure to subscribe for all things money and finance. Peace.